Evening, and I hope you are doing fine. So today we are going to look at a question. This question is coming from, as we saw in the recording, I shared chapter 3. So it's called Pyroso. And basically, it is a question that considers discounted cash flows, but as well putting in the aspect of international appraisal. So as well, let's first look at what is required of us. And the first requirement is to explain the role of the World Trade Organization and assess the implication of Pyroso of the Free Trade Agreement between Iran and MOTAG, the context of the World Trade Organization's requirements. Prepare a report for the board of directors, which evaluates the financial stability of the investment in Iran, discusses assumptions made with respect to calculations in B1 and above, as well as calculate the investment duration and percentage change in initial selling price required for the investment to have a zero NPV based on sales revenue. Then discuss significance of and concerns with respect to the calculation in B3. And then, of course, there are 10 marks that are given for communication, analysis and evaluation, skepticism, and commercial acumen, which, of course, as we keep saying, those are some of the marks that you should be able to get if you do the right thing. For instance, when they say prepare a report, you should say a report to the board of directors. Then they introduce give a body conclusion that gives you the communication marks. So if we proceed, having read the requirements, so it's a section A number, so it requires half of the time that you have in the exam, but make sure that you go through it a little bit fast because it's also bulky, as you should already be aware. Section A numbers tend to be bulky. So they are telling you here that they have given you some exhibits, and one is Pyroso's investment in Iran, and then the other one is investment appraisal details. So, of course, when we start with the exhibit 1, they say that Pyroso or Prysor is a multinational company based in the country of Mateg, where they use Mateg dollars. Prysor board is considering establishing a subsidiary in the country of Iran, where they use Iran D, so ED, to manufacture and sell new model mobile phone. So Iran has free trade agreement. This is what they are referring to here, in place with a number of countries, including Mateg, and trades on World Trade Organization's terms with other countries. So there seems to be two ways of treating countries. There are some countries where there's a free trade agreement, then there are others where they are trading on WTO terms. So, of course, this is where you have to understand what WTO does and why they don't like free trade agreements. We shall look at that, but this is one of those areas that you find that now you have to summarize because those are the theory parts that you probably may need for another question later on. So that is the first exhibit. The second one now talks about the investment appraisal details. So you see that Price's board has specified a 4-year time horizon for the investment in Iran, but the subsidiary may operate for longer. So they have put a 4-year horizon, but the project may go longer than 4 years. So, but they can also consider selling it as a going concern. So these are the sales units and revenue of the funds that are estimated, and they are giving us in ED thousands for the revenue, and then they are giving us the sales units. So the sales revenue figures have been factored using the assumption that Pyroso will charge a unit selling price of ED 160 in year 1 and increase the unit selling price by 5% per year in years 2 to 4. So they have already told you that they have inflated the figures. All they tell you now maybe is for you to question whether the 5% growth per year is sensible when you are looking at now your skepticism and all, so that you can talk about that. But do not make a mistake of now inflating these figures again, because they have been calculated using that assumption. Then, so that means these figures are already inflated, just to emphasize that. So the new phone will require a component made in Mateg and charged at a transfer price of $7 in year one per unit. Then the transfer price will increase by the annual rate of inflation in Mateg each year from years 2 to 4. And then the parent company will achieve a pre-tax contribution of 35% on sales of components to the subsidiary in Ireland. So that is something that we are going to deal with. Then investment in the new phone is likely to mean the loss of future sales in existing phones. And the new product, if it's manufactured, the pre-tax contribution lost. So there is some contribution lost in the sales of the existing phone would be about $400,000 in year one, increasing by annual rate of inflation in Mateg each year from 2 to 4. Then other costs of the project are forecast to be as follows after inflating them. So you can see that most of the figures they are being given as inflated, but of course there are some where they tell us to inflate. You need to be able to track each and every one of those. So you can see these are the other costs, and the immediate investment in non-current assets will be 14.46 million EDs. The variable value current assets at the end of year 4 is going to be 3 million. That is expected to be. So you need to also maybe say, okay, but is it going to be though? Based on what you may give some reasons, because sometimes we don't get what we want. So when you are trying to sell your going concern, what you think may be realized may not be actually what you realize. So that is one of those points where you can now bring your skepticism. But this is they're saying that assuming that the subsidiary is not sold as a going concern and assets are sold individually, that's what they will get. But there is depreciation here, and they have actually calculated it for you for the first 3 years. And there's an balancing allowance of 2.7, assumed available at the end of year 4 on the basis of the forecast net realizable value. So they have done some computation for you on that basis. All these are things that the examiner is doing to reduce on the time that you would take to do a question like this, because they are trying to test for other concepts in this case. So Pyrrhus will pay tax at 20% in Ireland on the profits in that country. However, it will be exempt from the taxation in Ireland in the first 2 years operating there. So no tax for the first 2 years. All post-tax cash flows will be remitted to Pyrrhus in Mateg, and the tax there is 30%. There is a treaty between the two, and under those terms, the Pyrrhus will be assumed to have paid tax at 20% in Ireland in all the 4 years. So even those first 2 years where there is no tax to be paid, it is assumed to have paid tax in those years. Tax in both countries is payable in the year in which tax liability arises. So Pyrrhus is an opinion that it has sufficient working capital, and therefore they are not going to put any working capital for the project. Another item that has been removed for you. So if we move on, you see that the predicted inflation rates in the two countries are given to you. And the exchange rate right now is $2 for 2.6 ED for one Mateg dollar. And there is a discount rate of 14% that they should be used to assess. So basically, those are all the items that we need to be able to do our question. But the last part here is about sensitivity analysis, because there is a question on that. So we are concerned for the investment appraisal if the initial selling price has to be lower to establish the fund in the market. So remember, when you are entering the market, you may reduce the selling price. So they are worried what that is going to actually have as an impact. Then they're also wondering how long it will take for the investment to contribute to value. So the Prysor directors, the FD has suggested that we should actually use investment duration for this. And you remember last time we also did a question on duration, so some of those aspects should be able to come back on this. Okay, so let us now go and, of course, the first question is asking us about the World Trade Organization and then what implication it has for Prysor. But of course, I'm going to leave you to go and look at the solution to cover the biggest part of that. But I will mention that World Trade Organization is an organization that was set up, and the reason that the organization was set up is to ensure that all countries are trading on equal terms. So that is one of the things that you're going to see as being important. And actually, after that being something that you realize is important, the reason why the WTO does not like free trade areas is basically because they are basically not treating everyone equally. Like they are making some people incur higher tariffs when they are, let's say countries incur higher tariffs when they are importing or exporting goods. Whereas now these other countries that are within the free trade agreement are going to be benefiting on no tariffs. So basically that means that there is unfair treatment of the other countries. So the WTO wants everybody to be treated fairly. So that's the implication. But I will leave you to go and look at it specifically in the solution so that you get to appreciate more of what I'm referring to. What we are doing now, first of all, we are going to now to go and do the second part, and you could see clearly that second part is the one that carries all the marks that are left on this question, 46 marks to be precise. So it means that you need to give it your best, but also because these 4 marks are easy to get if you know the theory, and you can make them very fast. It's not a good idea to leave any mark and attempt it. So do those 4 marks very fast. Make sure I remember that you have 1.8 minutes per mark, and then you go to the next one like that. So let us look at accessibility of this project. So of course we are going to set up our cash flows. So now remember, what we are going to be doing is a report. So you are working in your Word document, typing out the report, and you are referencing the appendices. And appendices that you're referencing are going to be found within your Excel spreadsheet. So that's what we are going to do here. We're going to create our appendices. So you can call this one Appendix 1. Just call this one Financial. Financial acceptability. Okay. What you would have. So we're going to start first of all working from the Elan currency. So we are going to start with the working in thousands, ED. So you have the years 0, 1, 2, 3, 4. The project is for 4 years. So what you start with here, the revenue. And revenue, you already have been told that this is the revenue. So you don't have to calculate it again. So 8,000, 10, 9, 20, 14, 641, and finally 16, 670. So those are our revenues. And of course, just to format them well. So that is our revenue. And now, remember what we saw is that there is a component that's going to be required. So we need to actually put here the component. This is going to require a working. And this working, can put here working one, component cost. Now, this working of component cost, we know, of course, we are going to still need the years. We don't need year 0, so we can remove that. So we don't need the year 0 for the component cost. Now, for the component cost, you see that the transfer price, the nickel price component, which is going to be charged at $7 per unit in year 1, then it will increase by the annual rate of inflation in MATEG here to 4. So now, but it's per unit, so we need to actually have the units first of all. The 50,000, 65,000, 83,000, and we have 90,000. So those are our units. So then we can have the price per unit. And we are looking at it in first of all in dollars. So it's going to be 7 in year 1, and it grows by inflation in years 2 to 4. Now, inflation in MATEG. So this is the inflation in MATEG. So you can have this, you can organize it how you want. I'm just going to put inflation. Okay, so let's just do the computation by just referencing the inflation. So in year 2, 9%. Then in year 3, 8%. Then in year 4, 7%. So those are our figures per unit. So I can actually have the component price in the dollars when I now consider also now the units. Okay. So of course that's just going to be a product of the units times the price per component per unit. So that gives us the amount in United dollars. So now I need the exchange rate. Now, so the exchange rate, they gave us the current one is at 2.6. Gave us at the moment 2.6. Now, of course, you may have to do a working so that you can get the others, but let's do it from here. So this is the current one. So even year one, we are going to have to inflate. So now we have not seen this yet, but in the notes and videos, it's there. When you are going to do inflation, you need to use either the purchasing power parity or the interest rate parity. And so I'm just opening the formula sheet. So here is what we want. So this is what we want. This is the purchasing power parity, the interest rate parity. And what you need to understand here is that basically what you need is the current spot multiplied by 1 plus HC or 1 plus HB, where HC is the counter currency inflation and HB is the base currency inflation. So that's what we want to get. And from here, the way they gave us this exchange rate, you can see that the Matek dollar is the base currency. Therefore, we are going to use the Matek inflation as the base inflation and the ED as the counter inflation. So for year one, we shall start from year one, multiplied by 1 plus inflation in the counter currency, as we said, is Elan, so 6%, divided by 1 plus inflation in Matek, which is 10%. So that gives you 2.5505. Then we get this one multiplied by 1 plus inflation here, which is 4%, divided by 1 plus 9%. That is for year two. Then year three, you do the same, multiply by 1 plus 3%, divided by 1 plus 8%. And finally, in the fourth year, you multiply by 1 plus 3%, divided by 1 plus 7%. So which gives us our exchange rates. And you can now find the component price. And now we want to get it in ED thousands because we want to take it there to our worksheet. Now, first of all, if I want to change from Matek dollars to ED, you need to see that we are converting from this currency to the counter currency. So we are going to multiply. So that means that we are going to multiply this by that. That gives you 876,909. But this is want it in the thousand, so we divide by 1,000. So that gives us 877. Then when you drag it through, you get the figures for the rest. So that's what you are bringing here. Okay. So having brought our component costs, now we also bring the other costs. So for the other costs, we have been told that we have 3508. Then 4934. Then 6230. And 6685. They just notice that they all have to be negative. Okay. Now, so that we have our other costs, then we normally have to bring taxable depreciation, and ideally it should have been given to us as a computation for us to make, but they made it easier for us and they gave it to us here. It is 615. Then you have 2711. Then you have 2033. And they said also we have an allowance of 2701. Okay. So from there, we can get our taxable cash flows. So after getting that, these are our taxable cash flows. Now what follows is tax and tax. We are still, remember we are still in the cash flows that we are looking at in Ireland. So tax is 20%, but no tax in the first 2 years, which means that so year 1 and year 2 no tax, but there is tax in year 3, 20% of this total taxable cash flows. Then we just have to confirm something. So just to confirm that the component costs are okay. Okay, so So there is something that I think didn't come out right here in the price per unit. So let's see. So you're supposed to grow by inflation. So 987. So this should be 1.08. I think the 1.0 something didn't go there. So now that that is sorted, so I was worried that we have negative cash flows, which can also be possible if that's the correct thing. But in this case, this is not correct. We just made a mistake somewhere. But after doing that, you always have to add back depreciation because it's not a cash flow. So you bring it back. So after doing that, now you can bring in working capital, which they said we don't have. Then we actually now bring in the investment. And the investment is in year 0. And how much was it? 14,460. In the 4th year, there's scrap, as we saw, of 3.4. So you can put it on the same line. You can put on different lines. It's up to you. So from here, now we have our now our total cash flows in Iran. So now, ideally, what normally happens in this case is that after you have your cash flows in Iran, then you have to now put them you have to put them now in the this time Mateg dollars, because now you are remitting all the cash flows in Mateg. So you need the exchange rate. And the exchange rate, they gave us 2.6 in year 0. And we have got the others. So it's just up to you how you would have done this, or you would have created the working for exchange rates. But however way you do it, we have the exchange rates here. So we just bring them here. So after having your exchange rates, then what follows, then now you now have your cash flows in Mateg. So how do you normally what I do in this case to test is to see if I'm going to stay in thousands, because I've been in thousands here. Basically what I will do is to because remember I'm going to convert to Mateg, which is the base currency, so I have to divide. So if I divide this by the exchange rate, I get 5562. So it means that I can still work in thousands. So let me now get cash flows in Mateg, and I'm going to work in thousands. So that means I'm not going to change anything about how I've been rounding off or something. So I just come. So now that I have, so these are the cash flows or cash inflows from Elan. So basically dividing, and then you get your cash flows. So now what normally happens is that at this point you now see once you are here, what is going to be new. So remember the components, we are getting them from Mateg. So we are going to have some contributions from actually that. So we are going to to get, first of all, what you need to also remember is that there is a treaty. So tax has been paid at 20% in Iran, whereas it's paid at 10% in Mateg. So, and the treaty exists between the two, and it assumes that we have paid 20% in all 4 years, which means that they are going to charge us 10%. So we can maybe first knock that out of the way. So we can say additional tax in Mateg. So basically, we are going to go to this cash flow, which is taxable in Mateg, since it's assumed to have been paid 20% for, so we are going to just pay an extra 10%. Okay. But this figure that we have there up is not in Mateg dollars. So to convert it to dollars, we divide by the exchange rate. So when you drag through, that's what you end up with. So that's the additional tax in Mateg. Then also we have additional contribution, or we can say component contribution, because it was appearing as an expense in Iran, but the income is in Mateg. So they told us that the contribution, where is it? Transfer prices are going to be increased, that one we have seen, but contribution is 35% on the sales of the company to a subsidiary. So contribution is going to be 35%. So 35%, what you can do, you can bring the amount here, we take dollars, because we don't need to convert it to the exchange rate. So, but now this is in dollars, because remember this was, but we need it to be in thousands of dollars. And let's remove the negative because it's coming in as a cash inflow. So that becomes 123. So when you drag it out to the others, you get the additional contributions. Now, so since you already handled the cash flows and the additional tax on them, so then you just set tax contribution. And now this is going to be a full 30%. So that is it. But another thing they told us also is that there's going to be some lost contribution. And the lost contribution is going to be 400,000 in year 1, but it's going to increase by inflation in years 2 to 4. So lost contribution. So in year 1, 400,000, and in year 2, it's going to increase by inflation. So what is the inflation? In year 2, 9%. So 1.09. Then what's the inflation in year 3? 8%. And finally in year 4, 10%. So basically that's what you end up having. And what you need to realize now is that because they have lost some contribution, there is some tax relief on lost contribution. Because ideally that means that you are not getting that revenue, so that means that you are saving that tax at 30%. So it's going to appear as a cash inflow. So now we have our tax relief. So what else? I don't think we have any other cash flows that are coming. So we can now add back everything. So remember, the exchange rate is not a cash inflow, so don't put it on what you're adding. So basically now you have your figures for the total cash flow. Mateg. Now, so what follows next here is basically discounting. But we can actually do NPV right away without having to go to the discounting. Although, since I saw that they need to ask calculate duration, so let us get discount factor at, I think it was 14%, just to confirm, 14%. So I advocate that you use the formula in this case. Saves you from having to copy the figures. So you have your discount factors right there, very fast. So from here, we can get present value, basically the product of the cash flow, the discount factor. So once you have that, now you can get your NPV. So get your NPV, and it's 960, and it's a positive one. So since NPV is positive, the project should be accepted. Now remember, this is all an appendix. So we have set up our report. Like I said, you are going to say this report, then you as your introduction. So the report is going to be the board. Then you said this report evaluates the financial stability of investment in Ireland with the assumptions that are made. Then also looks at the project duration and also the sensitivity, the initial selling price, as well as the significance of the sensitivity. Basically, you get a way of summarizing the requirement in an introduction. So then you can now go and say the NPV of the project was calculated by getting the cash flows in Ireland and then converting them at an exchange rate which is obtained using the purchasing power parity into the cash flows in the MATEG, and which further cash flows were incorporated there, like the component contribution and the loss contribution, additional tax to be paid, to come up with an present value of, then you put the figure and you say Appendix 1. And then you say since it's positive, it should be accepted. Okay, then you realize that I have now brought the calculation in 2 words, but you don't have to describe every single detail that you have done in the computation. You just have to summarize it the way I have done. And for this, I'm going to let you basically look at the solution to see how it is worded very well, so that you know what to write, but of course try to be summarized because of the time constraints and all. So then you go on and now we discuss the assumptions, and assumptions that we are making are respect to net present value, but also getting exchange rates using the purchasing power parity. They are the common assumptions that you find. Things like we are assuming that the figures that we are dealing with are accurate. Things that we are like we are assuming that the project is going to have that recovery of 3.4 when you sell the assets individually, and so much. And that's where you're going to basically get your skepticism marks, because you are now going to be saying, okay, this is what we are saying, but okay, what can happen? What really may happen? Something to that end. Okay, so having done that computation and of course discussed the assumptions, what should follow next is basically to do now the duration. Now the duration that they're asking for here is what you can also call the Macaulay duration. And of course, we saw it last time, but what you do basically for this duration, so let's do the duration. So what you do for the duration is basically getting the years, and of course we can borrow from up here. We need years from 1 to 4. We don't normally do the year zero figure for duration, and you will see why. It's because we are going to multiply by the year. So if the year is 0, that means that that figure will disappear. So we just bring the present values starting from year 1, and then so those were pulling from up. Remember, these figures are in thousands, so let us also still say here that we're working in thousands. Need to keep appraised of that. But when you are reporting your figure, you can report it in like 960,000, not 960, because 960 is not the answer, it's 960,000. So then you can now, so of course, you're going to add the present values all together. And then you are going to now also multiply the present value by the years. So basically 1 times 1905 and so on and so forth. Then you're also going to sum that one as well. So to get the duration, it's simple as saying that figure of present value times years divided by the present value, which gives you a figure of 2.86, and this is usually in years. So, of course, the history and the basics of why we are using duration as opposed to maybe payback period and all that, that is something that you can look through. Of course, you're going to have to answer the question when it comes to the theory part. So let us first catch. Now that we have done duration, let us also first do the sensitivity. Now, to get the sensitivity, they asked us that the sensitivity we are looking at is the change in initial selling price required for the investment to have a zero net present value based on the sales revenue. So it means that we are basically going to play around with the initial selling price. Sensitivity, okay, selling price. Now, there are things that are going to be affected by the selling price. So we can actually, first of all, bring our years. So ideally, the sales revenue was given to us. This is the one that we are going to manipulate. So we can first of all bring it here. So basically you can copy the ones up. So having your sales revenue here now helps you, because the thing is sales revenue, because what we're trying to get is the present value of the sales revenue, but the sales revenue, when there is tax involved, there's always going to be a tax element. So because there is a tax element, so we can need to calculate the tax on the sales revenue. And now what's going to be also different about this is that basically we are going to create something similar to what we had up. So we are going to start with the ED thousands. So what we have here is in 80,000, and tax was starting from year 3, 20% times year 3. So that was what you had there. And then the cash flows that ended up going as a result of the sales revenue were these ones. So those are the cash flows that ended up going as a result. So now when we take them to Mateg, so using the exchange rate, so now let's go and work in Mateg dollars. Let's try what we have done up, so don't get confused about that. So the exchange rate, and just pull out the exchange rates that we used from year 1. So those are our exchange rates. So then we can have our cash flows now in, so cash flows, you can actually just put cash flows in the Mateg thousands. And basically what we do is to just divide by 1,000, by the exchange rates. So you have your cash flows, and what happens after that is that there is an additional tax that had to be paid, which is 10%, and it is on this figure here, the sales revenue by 10%. But since this figure here is in AD, so we have to convert it to Mateg, we divide by the exchange rate. So that gives you additional tax that has to be paid on that. And basically, those are the things that the revenue is going to affect. So you can now have our cash flows. Don't add the exchange rate, it's not a cash flow. So we have our cash flows. So then we can get the discount factor. That one we can actually just copy everything from up here. Because if I copy discount factor and, okay. So anyway, something's going to change, so it's fine. Discount factor, let us make this one reference the years. You can make it reference the years that are here near us. So those are our discount factor, year 1, 2, 3, 4. Present value is just the product of that, and you get 11,867. And of course, you know how do we calculate sensitivity? Normally calculate it as the net present value divided by the present value of the variable that we are looking at in most cases, which means we are going to say net present value, since we are working in thousands, just do 960 divided by 11,867, and you get 8.09%. Because it is for sales revenue, we are worried about it decreasing. So it's supposed to be negative 8.09%. And what does this mean? It means we are worried that if the initial selling price falls by 8.1% net present value, the project will become 0. Because now you know what implications that has. Means that that project no longer becomes viable, and we should therefore not actually accept it. So basically, that's what that is going to need us to do. And what I want you to now appreciate, because we have now finished the calculation and everything, and basically we are going to be discussing the significance of that. And it's always a good idea for you to get this from when you go to the question and look at the solution, that you can see basically what they are referring to. But as I've just told you, we have duration, which is about 2.86 years. And the duration basically tells you approximately how long it takes for you to have the project have value. And it's the replacement of the discounted payback period and payback, because it looks at the entire life of the project, and it always it takes into account time value of money. If the project has a higher figure than 2.86, if you have another project and it has a higher duration, that project is more risky. The lower the duration, the better for investors, because they want to get their money back sooner rather than later. And then sensitivity analysis, I've just explained to you. Of course, as I said, if you got the solution, you find that they are covering that in great detail to try to explain to you the significance and the constants that you can have on that. So I don't want to prolong this session beyond that. And as I'm saying, better now for you to go to the solution and basically look at how the whole report has been laid out, and then learn a thing or two about how it is done, because that's basically where you're going to be getting these crucial marks now for communication, analysis, and evaluation skepticism and commercial acumen. As well, if you got the solution, you basically see, let me just take you there briefly. So briefly, just to run you through what you need to be learning once you got a solution like this. The first thing that you need to see is that some of those questions have these answer tips. And this is a very important one, because as you have seen, this is a big and tricky international investment appraisal question. Although we have been able to do it in 1 hour, and I was talking through it. So it means that it is something that is completely doable. Although I'm not a student like you, so I'm not under pressure and all those things, you have to consider them. But still, given that we have done it in less than an hour of all the computations, you can easily be able to do this question and finish it. But the examiner identifies that it's big and tricky, and some of the calculations are tricky if you didn't know them, that is. So, but you should know that when you're attacking such a question, you don't need to get everything right to pass. Okay? There are so many things that you could have been able to do here and passed, get the pass mark for this paper, which means that if you get 25 out of 50 in that exam, you have a pass mark for it, and then you can get the other marks from somewhere else. But I recommend to strive to get at least 30 plus out of that question. So, but basically that's what they are saying here, and it's always good to look at such advice, because it makes you aware that if you find that you have reached a point and you're stuck, it doesn't mean that the world has ended for you on that question. You can always move and answer questions, other parts of that question that actually are doable. And then, of course, they go to the WTO. As I said, you read through that and the implications. Basically, the report starts from here, and the report has the introduction, which, if you read through, it summarizes the question very well. And the way they have laid this down, they are starting with assumptions. It's okay. They're starting with assumptions. You can read through them, and then you figure out what they are saying. And then the duration is here. scientific analysis and explanations of how everything comes into play. And then it has to conclude. So these are the things that you want to make sure that you have a body right after the introduction, then you have the conclusion afterwards. So in this body, that's where all yours the question that I asked of you on that part of the report should be. You can use subheading so that the examiner can easily see what you're trying to answer. So, of course, the appendix comes next where they go through the computation as we have been doing. So you can find and then they are giving you scientific computation of this and sensitivity. And of course, they come here down and break down the marks and how they are allocated on the marking scheme and explain to you a little bit of how you get those professional skills. So this is something that I want you to do every time you do a question. You go through the solution after you have attempted by yourself, so that you see what you've said differently, what was done differently from you, and you learn what is the correct way of doing it. So that's basically it for today. Thank you very much, and I'll see you next time.